Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Abbott Laboratories' annual report. Abbott Laboratories offers a diverse range of healthcare products worldwide through its four main segments: established pharmaceutical products, diagnostic products, nutritional products, and medical devices. The company's pharmaceutical segment provides generic medications for various conditions such as pancreatic insufficiency, irritable bowel syndrome, and hypertension. It also offers anti-infective clarithromycin and influenza vaccine. In the diagnostic segment, Abbott Laboratories offers laboratory and transfusion medicine systems that enable immunoassay, clinical chemistry, hematology, and transfusion serology testing. The company's molecular diagnostics products automate DNA and RNA extraction, purification, and preparation from patient samples, detecting infectious agents. The nutritional segment provides pediatric and adult nutritional products, including infant formula, while the medical devices segment offers rhythm management, electrophysiology, heart failure, vascular, and structural heart devices for cardiovascular diseases. Additionally, Abbott Laboratories offers diabetes care products, such as glucose monitoring systems and neuromodulation devices for chronic pain and movement disorders. The company's product portfolio also includes point-of-care systems, cartridges for testing blood gas, chemistry, electrolytes, coagulation and immunoassay, rapid diagnostics lateral flow testing products, molecular point-of-care testing for various infectious agents, cardiometabolic test systems, and drug and alcohol tests. The stock price of Abbott Laboratories, ABT, has dropped significantly over the past year due to a combination of disappointing earnings reports and safety alerts. In January 2026, the company released its fourth quarter 2025 results, which fell short of analysts' expectations in terms of revenue and financial guidance for 2026. This was followed by an FDA safety alert issued in December 2025, linking Abbott's Freestyle Libre 3 sensors to serious injuries and deaths due to faulty glucose readings. In addition to these events, the company's cautious earnings forecast in July 2025 and underperformance in its third quarter 2025 financials also contributed to investor concerns. The stock price dropped over 15% from an all-time high of $137.64 on March 3, 2025, to a low of $112.19 by February 19, 2026. The decline in Abbott's stock price can be attributed to the company's struggles with its product portfolio and growth trajectory. The disappointing earnings reports and safety alerts have raised concerns among investors about the company's ability to meet expectations and maintain its market share. As a result, the stock price has taken a significant hit over the past year. Abbott Laboratories' market capitalization of $195 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Abbott Laboratories holds a significant advantage in their industry. Abbott Laboratories trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 3.83 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 41% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.25%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. In terms of growth, the medical devices segment is experiencing double-digit expansion across various subsegments such as diabetes care, heart failure, electrophysiology, and structural heart. This segment is expected to grow by plus 12.6% in 2025 compared to 2024. The established pharmaceutical products segment is also showing a positive trend with growth rates of +5% and +6.6% in 2025 compared to 2024. On the other hand, the nutritional products segment is experiencing a decline in revenue, with a drop of -0.4% in 2025 compared to 2024. The diagnostic products segment is another area where revenue is declining, with a decrease of -2% and -4.3% in 2025 compared to 2024. However, the company's acquisition of Exact Sciences Corporation for $21 billion is expected to boost its presence in the cancer diagnostics market in 2025. Geographically, the United States is experiencing revenue growth of +5% in 2025 compared to 2024, while Germany and China are witnessing declines of -8% and -13%, respectively. These trends indicate that the company's revenue growth or decline is largely driven by its performance in specific segments and geographic regions. Net income experienced fluctuations between 2023, 2024, and 2025. In 2024, net income increased by $7,679 million compared to 2023. However, this trend reversed in 2025, when net income decreased by $6,878 million from the previous year. Furthermore, a comparison of net income between 2023 and 2025 reveals a decline of $1,199 million. Profit margins also underwent changes during these years. The operating margin increased from 16.2% in 2023 to 18.2% in 2025, representing a rise of 1.9%. In contrast, profit margins decreased in the diagnostics segment from 24.4% in 2023 to 19.5% in 2025. The reasons behind these changes are multifaceted. One contributing factor was the increase in rebates and allowances, particularly in nutritional products and diabetes care businesses. Additionally, an increase in tax expense related to a deferred tax asset in 2025 also played a role. The acquisition of Exact Sciences Corporation in 2025 for approximately $23 billion likely had a significant impact on the company's financial performance during this period. The company's financial performance indicates a positive trend in operating cash flow. According to the provided information, net cash from operating activities for 2025 was substantial, reaching $9.6 billion on page 36 and $9,566 million on page 44. This significant amount of operating cash flow suggests that the company is generating sufficient funds from its core business operations. A closer look at the data reveals a slight discrepancy in the reported figures, with page 45 showing an operating cash flow of $4,419. However, this figure appears to be an anomaly compared to the much larger amounts reported on pages 36 and 44. Despite this minor inconsistency, the overall picture remains positive, indicating that the company is generating sufficient operating cash flow to support its business activities. The company's debt level has undergone significant changes over the past few years. Initially, it increased by approximately $7.1 billion to $12.9 billion as of December 31, 2025. However, this increase was partly due to the absorption of Exact Sciences' estimated $1.8 billion of net debt. Despite this, the total debt outstanding decreased from $14.1 billion in 2024 to $12.9 billion in 2025. Furthermore, long-term debt at December 31, 2025 was $12.8 billion, a decrease from $13.7 billion in 2024. In contrast to the fluctuations in debt level, interest expenses have shown a consistent downward trend over the past 2 years. In 2023, interest expense was $637 million, which decreased by 12% to $559 million in 2024. This trend continued in 2025, with interest expense decreasing by another 12% to $493 million. Additionally, interest paid also decreased from $662 million in 2023 to $545 million in 2025. Overall, while the company's debt level has increased significantly, its interest expenses have decreased over the past 2 years. The company's performance varied across different segments and regions in the given period. On a positive note, the medical devices segment recorded impressive growth, with sales increasing by 11.9% in 2025 and 13.7% in 2024, while operating earnings rose by 17.2% in 2025 and 16% in 2024. The established pharmaceutical products segment also showed a steady increase in sales, growing by 7.4% in 2025 and 9.2% in 2024. Emerging markets were another bright spot, with sales growth of 5.1% in 2025 and 8.2% in 2024, excluding foreign exchange impact. However, not all segments fared well. The nutritional products segment reported flat results in 2025 due to price increases and lower volumes. The diagnostics segment also struggled, with sales decreasing by 4.5% in 2025 and 3.9% in 2024, accompanied by a decline in operating earnings of 16.1% in 2025. In the U.S., the nutritional products segment faced challenges, with total pediatric nutrition sales declining by 0.7% in 2025. The performance of adult nutrition sales was not specified. Overall, while some segments and regions showed strong growth, others experienced decline, indicating a mixed performance for the company. Management is expressing concerns about various factors affecting the company's outlook and strategy. One key concern is the regulatory environment, which may impact product compliance and marketing efforts due to safety and efficacy concerns. In addition, management anticipates increasing cost containment efforts from governments, payers, and providers, as well as changes in healthcare systems, including modifications to the Affordable Care Act. They also expect increased complexity and enforcement in data privacy and security regulations. Management is aware of potential disruptions to global supply chains, which could negatively affect results of operations. They are also cautious about acquisitions and strategic alliances, which may incur significant expenses and impact profitability. Furthermore, management notes that adverse changes in tax laws, regulations, or interpretations could have a material adverse effect on the company's effective tax rate, financial condition, and results of operations. However, management is optimistic about investing in product development areas for strong sustainable growth over several years. They plan to focus on driving sales growth from Alinity's suite of diagnostic instruments and rapid diagnostic testing systems, as well as grow digital health solutions and expand market position across various businesses. Management also intends to vigorously defend its filing positions in all jurisdictions with unresolved tax matters and continues to monitor legislative developments related to the OECD's Pillar 1 and Pillar 2 proposals. They believe that their available cash and cash equivalents, along with their ability to generate operating cash flow and continued access to debt markets, are sufficient to fund existing and planned cash requirements. Overall, management is taking a proactive approach to address potential challenges while investing in growth opportunities to drive long-term success. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has expanded its portfolio by acquiring Exact Sciences Corporation on November 19, 2025, Bigfoot on September 22, 2023, and Cardiovascular Systems, Inc. CSI for $851 million on April 27, 2023. These acquisitions are expected to bring in new technologies, products, and expertise that will enhance the company's offerings and competitiveness in the market. On the other hand, the company has also made some strategic divestitures to streamline its operations and focus on core businesses. The Zone Perfect product line was discontinued in 2024 as part of the nutritional products segment, while COVID-19 testing-related sales declined due to a decrease in demand. The acquisitions and divestitures demonstrate the company's commitment to adapting to changing market conditions and making strategic decisions that align with its long-term goals. By shedding non-core businesses and acquiring new assets, the company is positioning itself for future growth and success. The company has a history of paying dividends to its shareholders. This is explicitly stated in multiple sections of the report, including page 21, where it is clearly noted that dividends, yes. The consistency of this information across various pages, 24, 36, 37, 44, 46, and 47, further reinforces this fact. Regarding share buybacks, while it is mentioned on page 21 as yes, the report highlights inconsistencies in this information across different pages. This suggests that the company has indeed engaged in share buybacks at some point, but the details are unclear due to discrepancies in the data. Concerns about inventory buildup and supply chain disruption have been raised in various sections of the report. On page 9, it is mentioned that there are concerns about supply chain disruption, which is further emphasized on page 10. The potential for manufacturing problems due to equipment malfunction, raw materials issues, or global supply chain problems also adds to these concerns. Furthermore, page 13 highlights a specific threat to Abbott's global supply chain in the form of tariffs and trade protection measures. This could lead to disruptions in the company's operations and impact its ability to meet demand. Additionally, there are indications of inventory buildup concern on page 76, where it is noted that inventory reserves have increased from $168 million in 2024 to $146 million in 2025. This suggests that the company may be holding onto excess inventory, which could be a sign of potential issues with supply chain management or demand forecasting. And that concludes the financial summary for Abbott Laboratories. Feel free to comment below, and I will be happy to answer them when possible.